Hey YouTube, it's Dimitri, and today I want to talk about the difference between finance, like traditional finance, and quantitative finance, and give a real world example here on credit. So doing credit scorecard modeling, which is fairly old and fairly straightforward and impacts many of you. It's not going to be some crazy, exotic derivative product or anything. But to really talk about what the difference is on how we've kind of evolved and why we're using statistical models now instead of traditional finance. So without further ado, let's just dive on in here. Okay, so what is a credit scorecard? You'll kind of see us talk about this in the industry, but it's kind of fuzzy for a lot of people. It's really just like your FICO score or like your TransUnion score or whatever score is out there that is a credit score. That's what we're trying to build out here. And the whole purpose of a credit score is to help separate people into different bins and groups and categories and give you some sort of number. And that number indicates more or less like the likelihood or expectation that you're going to pay a loan back. So if you have a really high credit score, hypothetically, you should be able to pay that loan back fairly quick, or you can pay it out in the full terms. Whereas if you have a lower credit score, the probability that you will default on this is going to be probably much higher than somebody who has a higher score here. So that's what credit scores are used for. You can go look up yours online. It comes with your credit card and all that today. And these are just basically giving you terms and conditions on loans. So one of these things that the credit scorecards are often built on, as I kind of mentioned, is called PD, which is probability of default. Banks use a fancy equation now called expected loss, which is how much they expect to lose on a loan. And expected loss is going to be a multiplication of probability of default, exposure at default, and loss given default. We're not going to go too much into the details on that, but we can think about PD, so probability of default, pretty simply. Like it makes sense, okay, what is the likelihood that you will default? And we can use that and we can just say, okay, we're going to make some sort of score based on that. So that's going to be the technical piece here. But going back historically, there's something called the 5 C's of credit here. The 5 C's, so I'm going to link a little webpage here you can go to. It just gives you a little more information if you're interested in reading up on it. But the 5 C's are going to be character, capacity, capital, collateral, and conditions. And character is going to be, your credit history, always making payments on time, that sort of thing. Capacity is going to be more or less like if you can repay a loan or not. So if you have a lot of money, you should be able to repay a loan quite quickly. If you have a lot of debt though, so your income to debt ratios, for example, so debt to income, DTI, these sorts of things, these are things to consider because you might make a lot of money, but you might spend a lot of money. And so that's extremely risky and we need to consider that. The third one is going to be capital. Capital is going to include just like the assets and things that you have, for example, savings, investments, and houses, things like that. So if you couldn't make the payment for some reason, could you liquidate something else that's like an asset or is savings or cash or some other sort of money put away, and could you use that to make a payment? Right? It makes sense that if you had a lot of other assets, you could pay that loan back if you needed to. And then the fourth one's going to be collateral here. So loans that are really great to be made by banks are like auto loans and mortgages because they're asset backed. So there's some collateral on that. So if you default on your mortgage, the bank can take your house back and hopefully they can, sell off your house to somebody else and cover their losses and complete your loan out. Same with cars and things like that. Unsecured lending, so unsecured lines of credit here, for example, as well, would be things like a credit card. So you just give me a limit, like, okay, you have a $10,000 credit card limit and you can spend up to $10,000. Now, the issue with this is it's unsecured. There's nothing behind that card. So if I don't make the payment, they're gonna have to try to send me to collections and go through this whole process. Some cards, though, will also do collateral. So if they want to make it a little bit safer, so let's say, okay, it's your first credit card, you look way too risky. If you put down, $500, for example, we'll give you a $2,000 line of credit on your credit card. And then if something happens and you default or something goes wrong, we'll pull out of that $500 to kind of help make them whole again. So collateral helps reduce the risk, which is why things that are asset backed, like mortgages and auto, for example, are really safe, or at least safer than things that are just like personal loans or credit cards, where it's like I'm just giving out money as a bank to an individual and you hope they pay it back. So that's what collateral is going to be. And then number 5 is going to be conditions. And conditions are going to apply to both the consumer or the individual or corporation that's taking out the loan, as well as the economy at the time. So for example, how is this loan being used? So me thinking about student debt here, I would like to do this. I mean, I don't work in the student loan debt space, but thinking about like, what is that degree going to get that student? So maybe they're taking out a loan for a degree, and maybe it's a STEM degree, which we all know pays a little bit better. So maybe they have a better likelihood of actually paying that loan back. And those sorts of circumstances, you would expect that they are going to get a better rate. Now, that's not how a lot of this student stuff works with loans, but that's just an example of how it should work or should not work. Also, how you're using the money. Maybe you're going to use it to start a business, and starting a business is extremely risky in comparison to, buying a car. So those things need to be considered. Other things, for example, like interest rates, industry trends, kind of things that are out of the control of both the consumer and the corporation as well, but also things the bank's considering. Like, maybe it looks like a bad time and an economic crisis is coming around the corner. And so maybe they will tighten up their credit policy, which means they will make less loans to riskier people. And there just might be circumstances that are just external factors, like interest rates are kind of moving up or down. And so they're going to be more or less likely to lend just solely based on the fact of how the condition is in the economy. So these are kind of the 5 C's here. And historically, what's happened with the finance industry is they went out and they used these 5 C's, and you'd submit some sort of application. You'd say, okay, my name is Dimitri Bianco, and I want a loan. Let's say, I don't know, I need a credit card loan, for example. And you give them all the information, and they would go through and they look at these characteristics and say, okay, let's go through the character, capacity, capital, collateral, and conditions here. And they would have basically information they'd collect on you, and they would try to assign some sort of numerical weight to this. And so banks kind of figured out over time that things like income or like LTV, so loan to value, or DTI, debt to income, these sorts of factors were really meaningful. And so they would give them a higher score. And then some things, different types of products, whatever, they look at capital and they might say, okay, like the capital piece is okay. We don't really expect them to have a ton of extra money, so it's going to have a little bit of a score, but not a lot. And anyways, they'd keep going down the list of these different kind of factors and variables, information they knew about the customers. And then based on that, they would either agree to make the loan or they would not agree to make the loan. And they would look at different conditions and set interest rates based on more or less kind of this scorecard they developed. And they just kind of used experience to assign the numerical values to these credit scorecards here. And again, there's not like a capital number. So one of the 5 C's is capital. They wouldn't say, okay, your capital is X. They would have kind of like information they would gather on you. For example, like DTI, so debt to income, which I keep mentioning here, but debt to income would go into like the capacity number here. And maybe even if you look down more like at the collateral level, so something like loan to value, so the value of the asset they're borrowing against. And they try to figure out, is that meaningful or not? And it would go into one of these 5 C buckets. And again, a numerical value would be applied to it, and they would add all these numbers up. And at the bottom line, you'd have some sort of score here, which would add up. So let's say, hypothetically, the maximum score is 100. So you can add all these categories, and they'd weight them differently. And they would go through this process and do loans. And so in the olden days, like the 5th C here on conditions is kind of sketchy in the sense that, they might have external factors that weren't really important, or, they're just bad practices, or it's like, I just didn't like that person. And so they might have some fudging here and some fudging there. And it was not the best practice, but it was the best thing they had going at the time. And over time, it was kind of sketchy as well, because you can realize some people that were underwriting loans, which is what this process is, they were really, really good at it, and they could really nail down like who was going to pay back the loans based on this scorecard system they kind of developed here. Now, that's traditional finance. We still even live by the 5 C's. We still talk about the 5 C's, but banks have gotten far more, sophisticated, and we started figuring out we need to do this with math and stats and do this statistically here. And before I get going too far into this, I just want to point out too, if you go onto FICO's website, so myfico.com, I'll put a link in the description below for this exact page. It shows this little wheel here, and they give you general fuzzy categories so you can kind of get an idea of how the score is calculated. But they have 30% of their FICO scores based off of the amounts owed. 35% is payment history. 10% is going to be credit mix. 15% is going to be length of credit history, and 10% is going to be new credit. Now, there's a whole list of variables that fall into these categories, which is what we're going to talk about now. And that is going to be statistical models here. So instead of me saying, oh, I think, your LTV is, ranked, I don't know, maximum of 20 points, and it's based on the scale that I've created. So you get 10 points out of, 20. What we're going to do is look at numbers and data statistically, and we want to score somebody equally and fairly across the board here. So one big advantage using quantitative finance is it reduces the amount of bias, whether it's intentional or unintentional biases here. It reduces it because everybody goes through this exact same numerical statistical calculation here. And the way these models are built, so these are usually logistic regressions or something like gradient boosting decision trees. So if you're not familiar with the modeling frameworks, logistic regression gives you a value between 0 and 1, and it's going to be the probability. So the probability or likelihood that you're going to default here, I'm not going to use it interchangeably because they mean slightly different things, but the probability that you're going to default is going to be between 0 and 1, where if you had a probability of default of 0, right, you're super, super safe. If you had like a 0.999, you're super, super risky. And again, most people are going to fall in the range of probably, like around 50-ish. So we're going to try to predict these probabilities, but instead of now me kind of guessing and checking and using expertise and trying to like think these through on a financial theory standpoint, and again, we still use the 5 C's here, but now we're using more data because computers are around and data is freely available, and we can use models and modeling software, and we can build these models and calculate out scores much more accurately. Now, again, there's still a prediction here, but I just want to give you kind of an example of how this would break down. Each variable will often not be continuous. So for example, income, it doesn't scale based on like dollars. If you made, $10,000, I don't know, let's just say for the year, versus $10,010, the person with $10,010 wouldn't really get a different score than the person with $10,000. But we do what's called weight of evidence binning. And so we try to figure out statistically which groupings of that variable are the most alike given our probability of default. And so there's a great example here in this book I've been reading, which I'll link below as well if you're interested. But they give an example of like LTV, so loan to value ratio. So if you make a loan on a car for $40,000 and the car is worth $40,000, you have an LTV of 1. If you make the loan for, $20,000 and the car's worth $40,000, you have an LTV of 0.5. And when you end up in subprime space, often the loan is more than the car's value. So again, you have buckets and bins and everything, but you would look at something and you'd say, okay, if it's like less than, like, I don't know, we'll just say 0.5, then it gets a value of something. And if between 0.5 and like 0.76, it gets a value of this. But these numbers and bins are broken out by statistical modeling to group people into as similar groups as possible. So this isn't me looking at a sheet of paper and reading someone's name off there and saying, okay, it's Mary Johnson, and Mary has, this, and this. And yeah, I'm a little like hesitant. None of that goes into that anymore because now there's an exact calculation based on statistics, which is the quantitative finance part. And it helps us decide, okay, these individuals are going to have similar performance based on this one variable. And in a typical credit scorecard, you should have around 10 to 30-ish variables. And so just to give you a few other examples here, you might have like the oldest trade. So how long is your credit history based on the oldest account that you still have open? So again, it'd be nice to see that you had like a credit card and you've had it for 35 years or something, because it shows that you can manage your credit. You have the credit card, the limit's probably gone up on it, and you can keep making payments over and over. And so that's one other variable that would go into this. And then other examples would be different types of limits on your credit. So what is your, limit for credit cards? And in the industry, these are considered, for example, revolving lines of credit, because it's like you have, say like, I don't know, $10,000 limit, and you go out and you spend some of that money and you buy a bunch of stuff, and then it reduces, the amount that you have available, and then you pay it off, and then it becomes available again back to $10,000. So it's revolving. It keeps going back and forth. It's not like a solid state where it's like, I went out and I bought a house, and as soon as I pay off the house, it's just done. But you can look at credit in that sense of like there's revolving and then there's non-revolving. And for revolving credit here, right, you might look and say, okay, someone's got 3 or 4 credit cards. You'd add up the limits of all those accounts, and that would give you your total credit, revolving credit limits. And you can do total amounts of credit, for example, so how much credit's available through their mortgage and student loans and credit cards and all that sort of things. And again here, it's not necessarily saying that like if you have a lot of credit that you're really safe, but the model will model out and say, okay, if you have more credit, you're probably safer. But then it's taking into account, like your oldest trade, your LTV. And then, for example, another common one is utilization, which if you don't know, utilization is how much of those credit lines are you using. So if you had say a maximum limit, let's say revolving, because revolving is more predictive here than your mortgage isn't so predictive. Your mortgage is what it is, just kind of stays on the books for a long time. But revolving credit, you might look at it and say, okay, what is the utilization rate on the revolving credit lines? And you'd say, okay, they have that $10,000 limit, and every month they use up to about, $1,000 on it. So utilization rate is 10%. That's really good. Like you have a lot of credit, you don't need the credit. And so you're probably very safe because you can pay that off quite quickly. Whereas if somebody had, let's say that $10,000 limit, and every month that utilization rate's coming in at $9,000, which is a 90% utilization rate, they really need that credit, which is great. But what that indicates is that if you add on another loan for them, so you add another credit card or another car or another house or some other personal loan here, they're not going to be likely to pay that back to you. So even though you might feel bad and go, oh, they really need it, I can give them a bunch of money, I can give them more credit, the probability that they will default will be quite high. So you're not going to get that money back. And so that's really how quantitative finance differs from traditional finance here. So traditional finance was the same approach. It built this scorecard, and we kind of fine-tuned things over time. The banks did, and they got really good at it, and they knew what information they needed to look at based on those 5 C's. And then as modeling and computers and data became more and more and more available, we use that now more and more to actually model people out. Especially at bigger banks, very, very large banks can do snap, instant approval and rejection of loans, because they can run all your data from a credit bureau through their model very quickly and get an answer. And again, it is very unbiased in the fact that everyone's kind of getting the same thing. And then just to put a final blanket on this as well. So I talk a lot about model development. So these we developing these models. Model validation is the team that checks these models. And one thing that we look for a lot is, is this model biased? So there is a whole list of variables which we do not want in the models. Development teams know not to put them in the models. We often don't even get the data for these sorts of things. So, being honest and fair and transparent, banks do not use things, for example, like race or age or marital status. Like these sorts of things are protected classes. And so they're not actually used on loan decisioning, which is awesome. We want to have some transparency and some fairness and equality. And that's one of the advantages of using models over having individuals do underwriting on their own here. And if you're kind of interested in credit risk as well, I'll link that book as I mentioned below. But there's all kinds of cool things that we do with these models and how we build them and put them together. And it's a lot more complicated than just running a simple logistic regression. We start to build out things like gains tables, and we're trying to see if the model rank orders. Occasionally, I have spent time actually going back. So one of the big concerns I've had is using like a gradient boosting decision tree, which is machine learning methods. Sometimes things start to get too complicated, or there's too many variables, or it's too black boxy. And as a validator in my past life, I want to know, are we inadvertently discriminating based on age or on race or gender or something else? And so I can actually take this data, and we can use these gains tables, for example, and I can sort data to see what are the differences between different ages, for example. We want to make sure that I'm not giving someone that's, looks super risky based on their LTV and their oldest lines of trade and, how much money they make, so their debt to income ratios and, length of credit history and that sort of thing. I want to make sure that everybody's getting treated fairly based off of different age groups and categories. Now, you might have analytical pockets where it's it makes sense. For example, your oldest line of trade and older customers is going to be longer, right? But that's not a discriminatory practice and trying to narrow down and saying, oh, we're benefiting this group or that group. But we want to make sure that these models don't have some sort of bias where it's I have, 2 people that look the exact same, that have almost the exact same characteristics. And for some reason, somebody's getting a very, very vastly different outcome here. So we do pay a lot of attention to these sort of things. And there's all kinds of cool analytics to make sure that your model ranks your risk correctly. And then also that it actually bends and breaks people out into the correct categories and different groupings here. And again, what a lot of times, as I've mentioned, development doesn't even know like we have no personal information. So it's been awesome on development when I've worked in development teams. They strip all the personal information out. So I don't even know your address. I don't even know your gender. I don't know your name. I don't know your protective information like social security number. Developers often don't see any of that and have no access to that, which is amazing because it makes really unbiased and fair models. But again, that's how credit risk works, guys. I just wanted to show you kind of an example because people ask me a lot, what is the difference between traditional finance and quantitative finance? And then people start talking about investing and it starts getting blurry on like, well, this is kind of like a model and you can kind of do this in Excel. And so is it that quantitative finance? I've been doing that, for so many years and there's this big debate over it. But this hopefully shows you a little bit more why you need statistics, why you need mathematics, and again, why you need computer science and programming so we can automate these and get these all programmed in here. And also so how we can explore the data using statistical languages like SAS, R, and Python. So anyways, thanks for listening. Thanks for watching. And as always, until next time.